Welcome to The Explainer. Today, we're going to become financial detectives. We're going to dig into a company's financial reports to uncover its true health, separating the official story from the cold, hard cash reality. So let's just jump right in with a question that might sound a little crazy, but it's at the very heart of what we're talking about today. Can a company that's reporting millions in profit actually go broke? The answer, and this might surprise you, is a big yes. To get our heads around how that's even possible, we first need to understand something I call the profit mirage. It's this idea that the profit a company shows on paper isn't always what it seems. And this really gets to the heart of the mystery, doesn't it? A company's income statement can paint this beautiful picture of success, of huge profits, while behind the scenes, the cash register is basically empty. So, how does that happen? Well, it all boils down to two key figures in a company's financial report. You can think of them as two different characters in a story, each one telling you their own version of events. So on one side, you've got net income. This is the official story, right? It's the number you see in all the headlines. But then, on the other side, we have the ground truth, operating cash flow. This is the actual cash the business generated. So why the difference? Why can these two stories be worlds apart? It all comes down to a concept called accrual accounting. This system lets a company record a sale the moment a deal is made, even if the customer hasn't paid a single rupee yet. It's kind of like counting your chickens before they hatch, you know? But operating cash flow, it cuts through all that noise. It doesn't care about promises or IOUs. It only counts the hard currency that has actually landed in the company's bank account. And that, my friends, is much, much harder to fake. So here's the big takeaway. In a really healthy, high-quality company, the official story and the ground truth, they should line up pretty closely. The net income a company reports ought to be backed by a similar or, hey, ideally an even higher amount of operating cash flow. All right, so we know what we're looking for, but how do we spot the trouble when it's there? Let's open up our detective's toolkit and learn how to crack this code. We're going to zero in on the specific red flags that tell you when a company's profit story might just be a mirage. Just look at this chart. This right here visualizes the single biggest red flag you can find. The bar on the left shows a nice, healthy net income of 100. Looks good, but then look at the bar right next to it. The operating cash flow is all the way down at 40. This huge gap, what we're calling the cash chasm, is a massive warning sign. So what creates that chasm? It's a bunch of accounting entries called non-cash items. These are things that affect the profit on paper, but no actual cash is moving around. For example, a company might book a huge sale, which makes its profit look great, but if the customer hasn't paid yet, all that does is create an increase in accounts receivable. The cash is still missing. And here are the top warning signs you need to look out for. If you see that net income is consistently higher than the cash flow year after year, or there's a huge and growing pile of unpaid customer bills, or profits are being propped up by strange one-time gains, well, your alarm bells should start ringing. Okay, theory is great, but let's make this real. We're going to apply our detective tools to a little case study of two companies just to see these principles in action. Okay, check out this table. It tells the whole story. Look at that top row. Both Company A and Company B reported the exact same net income, 100 crore. On the surface, you'd think they're identical. But now look at the next row, operating cash flow. Whoa, Company A generated 110 crore in cash, even more than its profit. Meanwhile, Company B only scraped together 40 crore. Their cash stories are polar opposites. And the smoking gun for Company B is right there in the table, a massive 60 crore increase in accounts receivable. That means a huge chunk of their so-called profit isn't cash in the bank. It's just money they are hoping to collect from customers someday. So our investigation leads to a very clear verdict. Company A is showing high-quality earnings, its profits are real, they're sustainable. Company B, on the other hand, is showing low-quality earnings. Its profit is an illusion, a mirage created by aggressive sales that haven't actually turned into cash. So let's bring this all home. Why does any of this detective work matter to you? Why is it so crucial to look past that big, flashy profit number? Here's the bottom line. A company can't pay its bills or invest in new projects or pay out dividends with accounting profits. It needs cash. Cash is the lifeblood of any business. it's much harder to manipulate, and companies that consistently generate strong cash flow are simply more sustainable and, frankly, more valuable investments. And you can do this analysis yourself. It's really just a simple 3-step process. First, don't just look at 1 year. Compare the trends of profit and cash flow over several years. Second, calculate the ratio between them. And third, take a look at what's causing any differences. And if you're short on time and you just want one simple test to check a company's financial health, this next number is the one that truly matters. Here it is, the quality ratio. You just divide the operating cash flow by the net income. If that number is consistently greater than 1, that is a powerful signal that the company's profits are real and backed by cold, hard cash. This is your ultimate one-number test for high-quality earnings. So we'll leave you with this question. The next time you see a headline about a company's record profits, you'll know to ask the detectives question, "That's a nice story, but show me the cash." Thanks for watching.
Disclaimer. Educational content only. Not SEBI registered. This is not a buy/sell recommendation. Invest at your own risk.